discuss gold on the show. You know, we've all been talking about it. It's been a muted year as far as equity returns go. But, you know, for gold, we have seen a solid rise this time. So how much should you allocate to this precious metal? Which product should you pick? Because there are so many, really, right? So we have a complete explainer and at a good time, perhaps.
Oh, yes, absolutely. And, you know, gold has been shining this year. Let's see whether it will continue to shine. Kalpesh, thank you so much for joining us in the studio. That's really been the big question. Everyone's been talking about gold, the way we have seen this big increase in prices. Tell us, what is the strategy for any investor who's looking to nibble into this asset? What is the percentage they should have in their portfolio? Is it the right time?
Okay, so it's actually a good deviation to talk about something else apart from equity and debt. And this has been the one bright spot in the last 1 year, you know. So, you know, the way gold has delivered returns in the last 1 year is not without a reason. And as we all know that probably gold prices start rising when there is volatility in the global markets, and we've not had less of that at all in the past 1 year for unfortunate events which have happened, you know, the Ukraine-Russia war, or the high interest rates going up and inflation, and you have everything listed down, all of the reasons for gold to actually perform. And it has performed. So it has emerged a winner, and gold prices over the last 1 year we've seen have gone up to approximately 14% in 1 year. Whereas asset class like equity, true to its nature, has delivered a very tepid, like, you know, 1% type of a return. It's almost negligible. So on that count, it does not really, you know, say that this will continue or something like that. But it's time for us to re-look at our portfolios, because that is what is more important. Things will continue on the external front. And I've always maintained that macro investments should not, you know, macro events, in fact, should not dictate your financial planning per se, your own personal financial planning. So looking at that conventionally, still, I think gold should form a part of everyone's portfolio, but not more than 5 to 10%. You should not go overboard on gold just because it is shining, and not fall prey to, you know, people saying that there's no limit to it, because the moment things turn positive, I think gold will turn tepid.
Yeah.
So that's how I look at gold. And also, don't take an overexposure to gold for a temporary period, because it's not a trading type of a commodity or something, and it should be looked at as a part of your, you know, core portfolio, but up to 5 to 10%.
Okay, up to 5 to 10%. Kalpesh, for someone who's not familiar with, you know, with this entire space, just take us through what you see as the key advantages of getting into this space. Of course, you know, it is a safer bet, especially at a time of volatility like we've been talking about. And also for a new investor getting in, should they include some amount of gold as well? Because, I mean, while you're new, you do want to diversify, but is equity and debt enough when you're starting off?
No, so this acts as a great diversification to your portfolio.
Yeah.
And in finance, we always say that everything cannot be linear, you know. So this is that, you know, that little bit of a deviant in your portfolio, which has no relation to these two other things, as we just mentioned in the first segment out here. So gold, I would say that can be a part of the portfolio, but like what Pavitra, you asked, is it cannot be a starting point for any investor. So the starting point, the moot point, has to be your debt and equity, you know, investments through mutual funds. And then as you evolve in that, you understand the portfolio, how it moves, you understand the nuances of the market, then you can start adding gold up to that 5 to 10% in that proportion. And you can do it at, I think, your own pace. There's no need to time gold, because you need that much gold in your portfolio over a period of time. So because it has a negative correlation with relatively risky assets, I think it should form a part of your portfolio. And we've seen that during turbulence and negative in equity markets, this is your savior.
Okay, so that's about gold. We also have the mutual fund data which has come out, and the first tick just has been that March equity inflows are highest in a year. So I'll get to you on just a bit once we get more numbers on that one. But that is interesting. That is the highest that we have seen in a long time. But sticking just for a bit with gold, and then we'll get to that in a bit, Kalpesh. Many options. We have ETFs, we have sovereign gold bonds, we have the physical asset. How should one go about it?
So now we've got lots of options apart from the conventional physical gold, which we all Indians love to do for years now, you know. So first starting with, you know, we have the conventional gold ETFs. And gold ETFs basically let you, you know, buy it per unit, buy it at the real actual, you know, time you want to buy it. And it's attached to your demat account as well. So gold ETFs again let you buy in units as to whatever is your capacity to buy. Second, coming to sovereign gold bonds, which are obviously a sovereign, instrument issued by the government of India. And we've seen tranches coming out for the last 4 to 5 years. And the best part about that is that it gives you also an additional 2.5% interest per annum payable on that as well. Even the taxation aspect on a sovereign gold bond post this, taxation changes which have happened since 31st March. Probably in that sovereign gold bond up to 5 years, if you are able to, wish to withdraw, you still get that 20% with indexation benefit. And obviously, if you stay the whole period of 8 years, which is the period for sovereign gold bonds, you can get that amount tax-free. The only disadvantage with a sovereign gold bond is that if there's a liquidity requirement, a sudden liquidity, I think sovereign gold bond would not be able to fulfill that. And obviously, the third one is the gold-based mutual funds, which again are very, very liquid by nature. They track the real price of gold. Obviously, that small tracking differential would be there. And more importantly, it's a part of your core mutual fund portfolio, so you don't have to, again, relook at it in a separate way. So all these things put together come under the ambit of the the gold which is not physical, and of course then going back to the conventional physical gold which people want to buy. I think nobody can deter them because that's the mindset which has been embedded for years now.
Yeah.
But that also now is come under a lot of, limitations and restrictions by the government.
Yeah.
So to each his own.
Oh, absolutely. And, Kalpesh, we'll just get back to gold in a minute, but we do have the mutual fund number. So let's just take a look at that. Like Sonal was pointing out, this is the highest that we've seen perhaps ever. This is coming at over 20,000 crores. This is March equity numbers, 20,190 crores. Last month, what we saw was 15,657 crores. So there's a big jump there. For the hybrid schemes, we've seen an outflow of 12,300 crores approximately, but it is really all about the debt funds, right? So I'm just going to pull up that number for you.
We have that number. So the debt outflow is 56,884 crore rupees, which compares with 13,815 crores of outflows. So while you were discussing, right, how last 1 week numbers saw massive inflows, but it ultimately has been a big outflow, so to say, this time around. The highest in 6 months is what this number looks like.
Big outflow, but I mean, compared to what we've seen earlier, it's not quite as close as well. You do see this kind of numbers as well. But your first thoughts, Kalpesh, we have been talking about debt. Like you said, you're sick of it, but I still have to ask you, on this kind of number that we have seen. Of course, this was the last week rush in March. That we saw. How do you think it's going to fare from here?
So practically, like what you've covered, the thing that the only exciting part was that last week, and everybody wanted to capitalize on that long-term indexation part of it, and they did so. But I think it was around 30,000 crore or something which was there. But the quite the redeeming part or the positive part is the huge equity inflows. So what has happened, probably the way we make from this initial numbers is there's almost been a 30-35% spike up in that number from the last month figures which have come up. And I could probably attribute it to that the retail investors have really evolved and now understood that this is the time to prop up their equity portfolios when the markets have really not done well, and they have gushed in this money into equities for that. It also could be a part that some people could have done the last minute ELSS investments which could have come up during that period to complete their ATC allocations. So all that also could be a part of the equity inflows which have been really a great number to look at. So these are my initial reactions that the domestic investors, the retail investors, I think are evolving a lot. And we pray and we hope that this continues, because this is what is probably keeping our markets, afloat a lot.
Interestingly, we are talking about gold. Gold ETFs this month have seen an outflow. It's a small number, but since we are talking about gold here as well, we'll just hold on, and we also have another guest joining us, Mr. Anthony, the Managing Director and Chief Executive Officer at Mahindra Manulife Mutual Fund is joining us now. Thank you so much for joining us on CNBC-TV18. Your initial thoughts, the highest number that we've seen in terms of equity flows. What is your take?
Yeah, so very exciting numbers. I think it's, as Kalpesh was talking about earlier, it's a reflection of the maturity of the retail investor. We've had two significant events in terms of SVB and Credit Suisse, and I think that negative news then spurs investors to relook at equities, and the idea is to invest when there is bad news, because in the long term it pays. But I just also want to point out that it's actually been an exceptional month for fixed income. So if you look behind the numbers, it looks like an outflow, but I think all of that outflow is in liquid and overnight funds, which is a typical March end phenomenon. If you look at the net inflows in the longer term bond funds, and you were talking about that earlier, I think we've had more inflows in this month than in the last 12 months put together, right? So between the long duration funds, the gilt funds, and I think the target maturity funds that get represented in the ETF basket, I think we're looking at something close to 50,000 crores of net inflows in long-term fixed income. And I think that's obviously a reflection of the announcement that came through in the third week of March, and the fear of missing out, which kind of spurs investors to invest. So I would say an exciting month for both equity and fixed income.
It's been an exciting and eventful few weeks, like we were talking about. And I guess for debt, any money that was perhaps expected to go in the coming, few months is all just rushed in all at once. But another question I have is specifically, since we were also talking about equities, is on the large cap schemes. We've seen an inflow of over 900 crores for large cap funds. This is versus the 350 crores that we had last time. So there's been a big jump there as well. Your thoughts on this, Mr. Heredia?
So I think it's circumstantial. I don't think it kind of speaks to a trend. I think for a while there's been discussion around the fact that large caps perhaps find it toughest amongst all categories to outperform index funds or passives. And I don't think that story has materially changed. So I think it's just perhaps a reflection. Let me put it this way. I would believe there would be erstwhile SIP flows that obviously come into large caps. And if the redemption numbers in that category are lower, it could explain the delta between 300 and 900. But I don't see this necessarily as a trend change. I think the larger equity allocations continue to be to small and mid cap, flexi cap, multi cap, and so on and so forth.
Okay, we'll just come back to you in a bit. Kalpesh, we've seen that this time around liquid funds have seen an outflow of over 56,000 crore. To be precise, 56,924 crore rupees, which compares with an outflow of 11,300 crore rupees. The idea generally was that liquid funds, maybe they could be a good hiding place as well because of the volatility everyone was seeing. Savings interest rates had not been hiked despite the repo rate hike. What is your sense here, liquid funds? Is it something that somebody can look at?
Yeah, surely it should be looked at, because right now the spread is very narrow,
exactly,
and there's not much to choose. And between the the liquid category and probably the short term, or even extending it to the medium term, the spread is very narrow. So even you're getting a 7.1 or 7.2 on a liquid versus a 7.4 or 7.5. I think liquid is still very, very attractive. And even if you were to stretch that argument further in a liquid fund, or a little bit of an ultra short duration fund, compare it to a bank FD also, there's not much to choose from. So, and now the taxation is evened out. So there's nothing much of a differential. So I think liquid funds, even for the next 6 to 9 months, is a great place for people who do not wish to take any amount of risk and want liquidity at their beck and call.
All right, that's on these funds. But another question that I have is on the dividend yield funds. Mr. Heredia, this has come in at 3,700 crores for March versus what we saw last month was around 50 crores. Your take on this category?
It's an interesting category. I think it's a natural transition that the investor community is making from value funds, right? Which is something that saw reasonable amount of interest because, value has in some sense outperformed growth in the last 12 to 18 months. Obviously, dividend yields of the market and obviously the top 100 companies are much higher than they've been for the last 12 to 15 months. A lot of these companies also tend to be in sectors that I would argue seem to be more in favor. And I suspect that explains some of these inflows as well.
Okay, we are still awaiting the SIP number, of course. That is an important number also. It has been increasing more than 13,000 crore rupees for the last couple of months. But Mr. Heredia, thank you so much for joining us today and explaining to us what the flows this time around look like. And we'll just slip into a short break now. And on the other side, we'll continue our discussion with Kalpesh Ashar on investing in gold. Stay tuned. Welcome back. Still tuned into Mutual Fund Corner on CNBC TV18. We are discussing, analyzing the mutual fund data that we just got a while back. And additionally, we are also discussing all about investing in gold. So a lot to tackle right now. We've got a barrage of news. But while I leave it to Pavitra to crunch in some more numbers, let's get back to gold now, sure. Kalpesh, because we are talking about returns. I was telling you that gold ETFs this time around has seen an outflow. It's a small number compared to the big numbers you've seen this time around, right? But tell us, how do returns stack up, say, for physical gold versus ETFs versus sovereign gold bonds, and also now equities?
Yeah, so that's pretty interesting, So let's classify gold as one asset class because everything comes under that vis-a-vis equity. So if you see, we have the numbers here that 1 year returns we've already mentioned here because whatever has happened is gold has delivered 14% versus equity at 1%. You go back little in time, then you have the 3 year returns where again equity, I'm talking about the index funds. I'm not talking about mid caps and small caps here. So we're just talking benchmark index funds. That has given 3 years because of whatever happened, the Sensex jumped of the COVID period and all, 25% CAGR. And versus gold, which was 6% approximately at that point of time, 6 to 8%. And then generally is the real test where people say that I want to hold gold for a long time or I want to hold equities for a long time is where the real test comes. Yeah. And that is the real, differential part where equities tend to really outperform. And we've seen that equities CAGR is approximately 14% there versus gold, which is at 6%. So gold can never outbeat an equity, but it is also an inseparable part of your portfolio because it cannot, be seen in isolation and neither can it be compared. It's very unique for that matter. And many people also tend to say that I can only have debt in my portfolio, so be it. But I personally feel that gold being not related to these equity and debt, classes which are subject to so many other factors, I think has a mind of its own. So it does what it does and you have to be patient with it and not to confuse it with jewelry. Because that's where the real, people's mindset comes into picture. They said, I've got a lot of jewelry at home. But that conventionally in Indian culture has just been moving from cupboard to cupboard, locker to locker.
And generations to generation.
And generations to generation, absolutely brilliant. So I think that's the most important part. So the jewelry, what is there is decorative purpose, but when you have gold as physical gold through bars or coins, which is purchased officially, or you have your digital gold, I think that's a core part of your portfolio up to that limited percentage.
Okay, so we are going to come to you on digital gold also in just a bit. And there's no need to pick equities or gold, right? Like you were saying, it's not an either or situation. That is the whole point of diversification. But Kalpesh, at a time when gold prices have already run up so much, they are elevated. If someone is to get in now, what would you suggest? Do you think that they should do a lump sum investment if they can? Or do you still think that SIP route is better? Just considering that if prices come down, then, you might average at a lower price.
Yeah, so again, going back to the basic of percentage of your portfolio. So say hypothetically you have 1 crore of portfolio and you wish to create 10% of that. Now whatever your current situation is at that point of time, if an SIP permits or a lump sum permits, I think just reach that percentage is more important. How you do it is not really important, but I would prefer it doing it step by step. Because then again you have volatile periods going in between, but give yourself a little time frame that, okay, I'm going to complete my 10% allocation in the next 6 months, 1 year, or say maximum 2 years, and that's about it. And again, rebalancing is necessary of your gold portfolio as well. It cannot just keep ballooning up or shrink. So whatever it is.
Okay, so we don't have much time. Of course, the mutual fund data took us a lot of time as well. But last question before we let you go, 2 things. First, that these funds are passively managed and they provide similar returns to the benchmarks. Does it not matter too much which AMC do you pick? And in terms of the other question, that is, should it be SIP route, lump sum route? You did speak about that as well, but some more color on that.
Yeah, so practically I would prefer going with the known or the bigger AMCs as they are known rather than the newly introduced ones. And probably because of the gold as a commodity, I think it should be probably better in the hands of larger AMCs. Not saying that the smaller AMCs cannot manage it or something. This is my personal view about it. And obviously, like what I said, that reaching the target of your 5 to 10% is necessary, and stop. Because then people should not go overboard if the markets indicate gold in an uptrend or something.
All right, that point is completely taken. Just one final question on digital gold. What are your thoughts on it? I know you briefly mentioned it, but...
no, I think that's the way forward because the whole world in every aspect is turning digital.
Yeah.
So like what I mentioned earlier, keep the jewelry decorative confined to your home or your lockers. And digital gold is easy to maneuver, to monitor and to implement. I think if you want to have liquidity, immediately looking at gold, I think you can do it at the spur of the moment. You don't have to go to market to sell gold. So digital gold has its advantages. Tracking is easy. And like what we are heading towards, I think digital
There's no
space.
concern on purity and
no
stuff
purity, no storage problems at all. No issue of theft.
But isn't it more expensive than getting, say, a sovereign gold bond in terms of expenditure?
See, how much would it actually turn out to be if you do a real, point-to-point calculation? It might differ. Yes, you are right. But then in the larger scheme of things, you have something at your own, hands, in your own hands. And it would not matter in the larger frame of time. It's not like an equity compounding thing there. So that's what my take is.
Okay, all right. Thank you. That was a masterclass into gold investing. Thank you, Kalpesh, for joining us. And with that, we'll take your leave on this edition of Mutual Fund Corner today. Thank you so much for joining us. Stay tuned for Closing Bell to take you through the last hour of trade.